Are you curious about the growth potential of investing in India? So am I. That's why I reached out to Magunthan Siva, co-founder and chief investment officer at India Avenue. India Avenue is an Australian-based fund manager that specialises in investing on the Indian market. In this conversation, we walk through the key demographic advantages and the digital and physical infrastructure growth that has enhanced productivity in India. We discuss the difference between passive and active investing and why it pays to have active managers on the ground, even when it comes to some of the largest businesses that you'd find in a typical market cap weighted ETF. India Avenue have an active ETF under the ticker code of IAEF. Magunthan paints a compelling picture of a vibrant economy, and I hope you enjoy. Magunthan, welcome to the podcast, mate.
Thanks, Mitchell. Thanks for having me.
Let's set the scene on investing in India. India, for me and a lot of investors I've spoken to over the last 15 years, it's always had this real appeal as an emerging market, the demographics, the sheer population. But when I've looked at it in the past, it always seems like an up-and-comer that was always, had potential. But perhaps, like say, a decade ago, that potential was going slightly unfulfilled. Can you set the scene now for us as an investor on the ground in India around the demographics and policy that has shaped the current economic environment?
Yeah, so there's some truths to what you said. There's some that probably need to be explained. I think, if you look back 20 years, India has been one of those markets that's delivered upon its growth in its equity market. It's averaged somewhere close to the 12% mark per annum for Aussie investors over that period. So I think it's more about discovery, learning, knowledge that can convert someone from fearing India and thinking about it as, that's something I'll get to one day, towards, okay, that really is a market that I should have some exposure to. So I think that's the journey perhaps in the last 5 years where it's been more in the headlines. Post-COVID, the growth and the recovery has been strong. It's now moved up to the fourth largest economy. So we're having more conversations about it, which is increasing knowledge and thirst for insight from that market, which is leading investors towards it.
So the potential has been there. It has been fulfilled in as far as growth in the local market, and it's an education point that's now really kind of starting to unfold.
Yeah, that's right. I think very much as it's moved from a minnow within the emerging markets towards today being close to 20% of the emerging markets index as such, means the attention span of institutional investors to retail investors has been increasing.
And tell us about the demographics of India. It's the largest population globally. I believe it surpassed China in 2022. 60% of Indians are of working age, and that's an incredibly good structural advantage to have. And the median age, I believe, is just 28. Is that correct? Or roughly around those numbers?
Yeah, spot on. So if you look back in history, we had the US Industrial Revolution where there were a lot of, baby boomers post-war entering the workforce. Then you had Japan that went through a similar phase where it exported a lot of goods to the rest of the world, high quality, decent price, again, a younger population. Then China, then Korea. And so now we've got to the turn of India, where, as you said, a large proportion of the population is in working age. Perhaps going back 10 to 15 years ago, India's average age would have been very young. So large population, but not necessarily productively employed. So I think, you're now moving into the phase where population growth is flattening out, but productivity should increase from here, which should lead to more wealth.
Yeah, so I've got a note here saying that with 60% of Indians in that working age, that structural advantage is expected to last until at least 2050. So that's amazing for productivity. Let's talk about the policy that we've seen come into place. Can you tell me about the Jam Trinity?
Yeah, so essentially, one of the reasons why India is moving through to a phase of improved productivity is essentially it's become financialized, it's become digitized, and all these things have been linked to a national identity card. So there's a card called the Aadhaar card, which over 1.2 billion people have registered for and are using. It's a biometric system that links to your bank account and your mobile phone. So typically some of the inefficiencies of traversing India's difficult terrain and logistics where perhaps roads, rail were not necessarily connected as fluidly as in a developed or more mature economy, meant that, productivity was always held back. And India actually had a high logistics cost relative to its GDP. Now, some of these things through the ability of, subsidies, for example, that get paid straight to your bank account without leakage, or, being able to actually go and open a bank account very quickly, everyone having a mobile phone and increasingly a smartphone and internet is enabling a lot of these things where a farmer used to travel from a rural village to a more urban location, try and set up banking, try and exchange his crop in a market or a mandir, as they call it in India. All those things took time. So this whole productivity improvement is going to play out much quicker than perhaps it would have been, say, 10, 20 years ago.
And the Jam Trinity is playing into that. I've got a note here. It's broad because it's about bank accounts, the digital ID, and the mobile phone kind of infrastructure and revolution, and has brought about 1.2 billion Indians into the financial system.
Yeah, that's right. So essentially the starting point was that Aadhaar card. So, I can walk into an Indian bank today and open a bank account within 5 minutes because I have my card, which has everything linked to it and is a natural source of verification for everything that I do. So, this has really accelerated, I suppose, digital transactions in India. The country is the leader in terms of digital transactions, more than double that of China, which is hard to fathom. But the average Indian never used a personal computer. They went straight to a mobile phone in terms of digitizing.
That makes sense. And there's been that's a digital infrastructure that's there. And there's been significant physical infrastructure built as well.
Absolutely. The number of airports, roads, railway, travel routes, highways, national highway building has been significant. At one stage, it was averaging 35 kilometres a day in terms of road building. There's over the last 10 years, close to 100 new airports have popped up. You just think about it. 100? Yeah, that's right. So
I feel like it's been half my life that we've been trying to get Badgerys Creek in Sydney up and running.
Yeah, absolutely. So, I think even when you look at Indians, flying from city to city, flying internationally, that is taking off, but it's still at an early stage. So all these things are being accelerated by infrastructure physically as well as digitally, as we alluded to in the Jam Trinity.
Oh, fantastic. And I've got a stat here. It's quite interesting that in the last decade, there's been 98,000 kilometres of roads built. That's in the last decade versus 70,000 in the previous 63 years. It was quite significant. And so we've got the digitization. We've actually got people being able to move goods and themselves around a lot easier. What is this translated into for the actual economy?
Yeah, so it gives opportunity for, pan-India business to be done. If you think about what that means, typically when you have each of the states behaving in their own little sort of cocoon, then businesses thrive on local district or local state economics because they have a monopoly in that state due to the cost of logistics and the cost of taxes across states. But once you nationalize through things like GST, that was brought in India in 2017, you now have the ability also with infrastructure build out to lower the cost of getting your goods around the country. And also make it far more efficient and timely. So this means someone who's operating and looking to build scale and, economics of scale is able to do so and compete across regions rather than, having, I suppose, your economics being limited by the state that you operate in. So this is really, driving faster economic growth and is great for corporates who can, build capacity and expand at a faster rate than what they were doing before.
And Magunthan, I'm interested in just your personal kind of anecdotes. How long have you been traveling to India, just for personally and professionally?
Yeah, so look, in 2005, I was working for ING in Australia, and they asked me to be involved in a startup project to build an asset management / wealth management firm in India. So I moved my family over there, lived there for over 3 years. So that's 20 years ago. It seems like a long time ago. But I've seen, those were the boom days of India in terms of the stock market, really going through across, on the same platform as most emerging markets, really going through a development stage, fast growth. But when I look 20 years on, it's now not just stock market, it's also economic growth, which is progressing, and you're growing it from a higher base as well. So, getting 10% nominalized growth is no easy feat when your economy is already 4 trillion.
A lot of people will say emerging markets and that economic growth, where it kind of has some slippage, is that economic growth translating into market growth due to corporate governance. Can you tell us about that corporate governance kind of framework that is in India? Is it robust? And there's some clear examples of the robustness of it.
Yeah, so look, there's pros and cons to this story. So India's business has evolved through families, large conglomerates. So if you look at India's stock market today, which is the 4th largest stock market by country. When
you say largest, is that by like market cap size, the securities, number of securities? What when you say largest, what's the context?
So I'm talking about market cap. You've got the US, which is the largest. Then you've got China, Hong Kong. Then you've got Japan, and then you've got India. By security, India is close to, if not the leader, in terms of 6,000 plus listed companies. So being an aspirational culture and a lot of businesses evolving, being set up through the demographics and the dynamics of the markets means that its stock market, is one of the oldest. In fact, the Sensex is the oldest stock market in Asia, apart from Hong Kong. So I think when you look at India's history, that evolution from a family perspective, today it's still 40 to 45% owned by family or founders. So when we talk about governance, it's important to understand some of family ownership is great. We seek it. We hear fund managers talk about it all the time.
And in our market, you hear, at least half of fund managers say they're looking for founder-led businesses, with the name on the door, etc. So, yeah.
Yeah, but also it can be a poison chalice in terms of, is the family really doing the right thing by the minority shareholders who are also invested in the business, or are they looking to fill their pockets with cash flow and underreport accounting profits so that they don't pay taxes? when small businesses evolve to be larger ones through very strong secular dynamics and demographics, sometimes they can keep doing the same things that they did in the past. So when people mention governance in India, a large part of it is evolution of better practices, treating your shareholders fairly and evenly, and separation. This is the big one, separation of ownership and management. So, in some cases, we don't want too much separation because we feel the best people to run the business are the founding family. But as long as it comes with adequate governance so that everyone can understand the trajectory of the business and the decisions that are being made are aligning to everyone, not just the family.
Yeah, and I guess that's any market, isn't it, where it's a case-by-case basis and there's nuance to it. There's no one... There's a lot of founders in Australia that are harmful to their own businesses, and families in Australia that are harmful to their own businesses, and it's not just a wide sweeping generalisation.
Absolutely, and this is why if you are a proponent of active management, you will be, hopefully, if you can exhibit skill, be able to identify businesses that are owned by family that are going to progress because of that, deep insight and knowledge the family has built up in the business and the passion they have to take it forward, versus those who really have already made it in the world and are now trying to maintain that same pot of wealth for themselves. So, that really to me is one of the keys to active management.
If someone was looking at the passive side of things, right? Can you just tell people what's the local market called? What indices would they be looking at just to get a rough guide of the passive exposure or the passive return from the overall Indian market?
Yeah, so look, I would say probably the most well-known index in India is the Nifty 50. So that's the 50 largest companies by market cap. There is also a Dow Jones equivalent called the Sensex, which is the top 30. But either one of those indices would give you a fairly good guide of what you can expect from Indian markets.
One thing we actually didn't touch on, and I think this is really interesting to bring up, we're talking about the investing and the market maturity in India. Investing is becoming much more accessible to people in India as well. And the markets are now is the market open to outsiders now to foreign investment?
It's always been open, but you need a license. So that license can be cumbersome for obviously a retail investor, even up to an institutional investor. So typically most Australians would would seek exposure through a fund or an ETF. They do have 10 to 15 ADRs or GDRs. What are they? American Depository Receipts, an Indian company, but listed over in the US or London. But there's not too many of them. So, one of the best ways to get access to the story is through a fund because of that licensing requirement.
And domestically, I find this is really interesting because of that digitalization that we have seen previously. You've now got more and more Indians themselves building wealth in the local stock market. And so there's a thing called a SIPs, which is systematic investment plans. Can you tell us, because the numbers here are quite staggering, can you tell us what a SIP is and how much per month through SIPs is going into the Indian local market?
Well, as you said, systematic investment plan implies let's take one day in the month where money comes from your salaried account into your mutual fund account. Really this has come to the head over the last 5 to 10 years.
It's like micro investing here in Australia, essentially, where you get, a nominated amount, $50, $100, whatever it is, coming out of your bank account and going into a managed fund.
Yeah, dollar cost averaging, or in this case, rupee cost averaging. So essentially, what's happened is, 10 to 15 years ago, interest rates were higher in India. You used to be able to get 8% on a term deposit. Today, rates are lower. Unlike most of the developed economies, actually rates are lower in India. So what this creates is people looking for the best place to accumulate wealth. They're also becoming wealthier. There's more people moving into middle class and upper class. So they are looking to switch from physical assets like property and gold, which Indians have loved in the past, towards more financialized assets. They have a bank account. 7% of them now have a broking account.
7% of a lot of people is a lot of broking accounts.
100 million plus. So it's still a lot of accounts. And the number you alluded to is averaging around 5 billion US a month that's moving into equity markets. So, foreign investors are sometimes puzzled. Everyone's selling India, everyone's talking about high valuations, but why is the market not falling? Because today, the biggest incremental investor, families that own the 40 to 45% we talked about, they're not selling largely. But the biggest incremental investor is now mutual funds or local high net worth retail, rather than foreign investors going underweight, overweight in India, pulling money out, putting money in, which created some of the volatility of past decades that we come to know with investing in markets like India.
Yeah, and that's created a great level of market liquidity and market breadth as well, with all of these new investors coming into the market. And $5 billion a month US is quite a staggering number. That's that's rupee cost averaging on steroids. Interestingly as well, when me and you had a chat about this, I asked if originally if a lot of this money was coming into passive investment vehicles or active investment vehicles. And I believe the bulk is going into active management.
Yeah, so passive investing is still in its early nascent stage in India. The mutual fund industry itself really started taking off from the mid-90s and really didn't build up steam till perhaps 10 years ago. So active management has very much been, I suppose, at the forefront in India because most of the active managers have outperformed indices. And typically what you're finding as a result of this local buying over the last 5 to 10 years we alluded to is, a lot of the small and mid-cap stocks have actually done better because locals are looking for the next growth story. They're not looking for the already significant business that is at the top of its class in India. They're looking for the next version of that.
I'm interested, Magunthan, on your trips to and from India, at what point in time and what was the catalyst for you to say, you know what, I'm going to co-found India Avenue to invest there? Walk me through that process.
Yeah, so look, when I spent time in India, lived there, I suppose, to pardon the pun, been bitten by the Indian bug. And when I came back to Australia, I kind of felt, I'd seen the whole Japan, China, various countries go through this process. It's not a 3-year turnaround or even a decade. So I felt, for the rest of my career, this was going to be the market where perhaps the next Warren Buffett would emerge from, where the next long-term, wealth story was going to emerge from. And I felt also there was a huge opportunity in knowledge, in the sense that, not that I have great knowledge, but, I can ideally pass on what I've learnt to make an Australian and New Zealand investor feel more comfortable with what they were investing in. And I thought that was the largest hurdle that existed.
Right. So you saw opportunity. You saw the opportunity in the market locally, and it's interesting. Because some people will say, well, what does that look like over the next 5, 6, 7 years? You're thinking, no, there's decades to run in this. I could literally spend the rest of my career assisting people to provide them access to this, because you can see that return there for multiple decades?
Well, the Indian government themselves recently have come out and said 100 years of independence will take me to 2047. And by 2047, I want to be a developed economy. And to reach that sort of level, you would need an economic size of 30 trillion, which is 7.5x of today. So I'm sitting there looking at the numbers going, okay, what does this annualize at? 10%, not that much of a stretch, perhaps a stretch in the second 10 to 12 years. But in the first 10, if that's front loaded, that means that is going to be the economy to invest in because of that. It's the rate of change that is going to be at the greatest.
I'm curious as well. It all paints quite a compelling picture, which is why I'm actually sitting here talking with you today, because I'd started reading up on this and I said to myself, we need to learn more about this opportunity. It's a compelling picture, but can you talk us through some of the risks that confront India and that are maybe the emerging markets in general, but unique risks specifically to the Indian economy?
Yeah, so the geography of India, let's start with that. It's a positive and also a negative. It's, centralized in the map as such. So but perhaps India's ambition to become a more significant manufacturer and exporter will mean that it has many regions that it can trade with, given its geography. But it's also sitting and sharing borders with Pakistan, China, and the likes. So certainly it's a geopolitical hotspot. The Middle East is not far away. And we've seen some of the events even over the last couple of years where some of these regions have the potential to flare up. So that's certainly something to watch out for in the short term. We often think these can provide a good low point to keep adding to your strategic long-term story.
You can use that volatility.
Yeah, correct. Unfortunately, one of the bigger risks is that investors tend to invest at the top and pull out at the bottom. So I would feel in a market that you don't know about, you tend to react to headlines, and perhaps your long-term 12% that I said actually comes down to 5 because you've, trimmed and topped up at the wrong times. So that's certainly something to watch out for.
Do you find, being as a part of that emerging market group, that people tend to buy emerging markets as a whole, and the tide comes in, the tide goes out quite significantly? I know that'll be offset a bit, as you alluded to, by domestic investment. But do you see that happen?
Definitely. Probably the biggest obstacle to our business is the fact that most people feel they get India through their emerging market fund. And it feels safer to group 25 countries together and put them in a basket and say, okay, this takes all the volatility out and gives me a smoother ride. And, perhaps if it doesn't go well, then I switch to another fund manager that might do it better. So I think, what I would say is sometimes when there are 25 countries, you might have 5 to 10 good ones and 5 to 10 bad ones. So diversification isn't always necessarily your friend, particularly when you already have a broader portfolio and you're adding emerging market not as your sole holding, you're adding some exposure to what you have. So we would always say perhaps it's easier to understand one market and its fundamentals rather than grouping them together and saying, this is a group that I want to invest in simply for the title emerging or growing.
A box to tick.
Yes.
Hey, correct. I see all these diversified portfolios. They have, 5%, 10% to emerging markets. I'll go out there, get an emerging market ETF, tick that box, find the cheapest one, away I go.
And, to add, emerging markets ETF, I'm buying Taiwan Semiconductor, Samsung, some of the largest companies that are listed in those countries, not necessarily operating there. So perhaps your global manager would already identify that Taiwan Semiconductor is a great company, which it is. But really, with emerging markets, you're looking for those insights and companies that, not many people know about, that are their own gems in their own market. And for that, you need depth and knowledge of how that company works in its corporate ecosystem.
All right, let's talk about then investing in India from our Australian perspective. You have specifically chosen to go down the path of active management. You contract, am I right in saying this, contract analysts on the ground, so people who live and are on the ground and working for various fund managers in India. You've chosen to go down that route with local knowledge rather than take a factor or ETF style blanket wide approach to the local market. We've touched on the aspect of some businesses being run, say, with good governance, with minority shareholders in mind, and others being not so. Is that one of the major factors, or is there other factors that, there's significant valuation considerations, or is there, significant clumping in a market cap weighted ETF approach to sectors that you don't want to be overexposed to? I guess it's probably a mosaic of a lot of things, but what led you to say, no, we need active management in this area?
So I think, essentially the large part of that question is that governance angle that we spoke about before. You're going from perhaps poorer governance to stronger governance. There's a definite premium when you invest looking for better governance structures that create better valuation. So I think for us, the reason we partner with local fund managers is because they've been managing money in that market for decades. They will know the difference between Company A and Company B simply because of the family that runs it, or the track record of the founder, or by having conversations with their suppliers, their product users, consumers, their peers, their service providers. These conversations are invaluable to actually forming an opinion on the business's success. India's companies, about the top 100 to 150, have lots of broker coverage. Once you get beneath that, the broker coverage becomes sparse. And primary research is critical in finding that company that's, trading at a lower valuation because not many people know about it. International investors haven't loaded up on it because of, they're worried about liquidity and size and all those things. So how do you find that company and hold it for 10 years and see it go from stock 1,000 to stock 10? That's really the secret sauce of investing in a market like India.
How many analysts on the ground do you have?
So essentially, we today contract, as you mentioned, to 3 fund managers. So that would be their portfolio manager and their team of typically 5 to 7 analysts. So that would be our eyes and ears on the ground. They give us advice. So we have a contracted agreement for advice. Typically, they're managing their own portfolios for local clients, and we take a high conviction version of that as our advice. We combine the 3, and our job is to construct a portfolio that's robust by having 3 different styles, 3 different unique ways of picking stocks blended together.
And so how many stocks will you hold?
Typically, it would be between 65 and 70 stocks as a result of the combination of the 3. We don't want to hold, 150 stock portfolio because then that whole diversification that I talked about starts to come into play. But typically, our positions in companies would be anywhere from 5 to 6% down to 0.5 to 1%.
How do you incentivize those analysts, show me an incentive, I'll show you the outcome. How do you incentivize those local managers?
Yes. So one of the most commonly asked questions is, how do you know they won't be using you to front run all their positions? And questions that typically come because people feel, there's got to be something funny going on there, or something that doesn't make sense. How can it be a win-win? So typically, Indian fund managers have come to Australia, pretty much all of them. They find it difficult. Their pitch books are focused on India and why India is great, and they find it difficult to position India as part of a portfolio which Australian investors require. So what a lot of these managers have done is said, you guys are good at that. You're based in Sydney. You can have those conversations with investors about, hey, what role might this play in your portfolio? What sort of size should I look at, and why India in the first place? I can't give that color because I'm from India, so how can I discuss why India necessarily as well as you can? So typically they would look to work with us. They know that if their performance in their advice is not good enough, they can be removed, and we have done that to some managers in the past.
Right, so you can manage the manager.
Correct. And there has to be some friction there. It can't just be, we found 3 guys that are willing to work with us, so we've hired them. Certainly, if it's not cutting edge, if we're not getting insights, if we're not finding them advising us on companies that perhaps are not necessarily consensus, but some unique insight they bring to the table, then we can say, okay, we're not benefiting from this relationship.
And as well, nothing lasts forever, as in fund managers, they go through their fantastic periods and they might grow to a size where they become an institution and they lose that fire. Or staff members move on, team members move on, and you do need to manage that. Nothing lasts forever. Magunthan, that's fantastic. Let's talk about some of the actual stocks in the portfolio. What do if you can give us a bit of an idea about the types of companies that you're investing in, and the what is making you excited about the portfolio at the moment?
Yeah, so I'm going to answer that in a second, but also come back to a point that you just brought up. So when we look at fund managers, we look at those that are led by investors. So they're not talking about my assets have grown, they're talking about their alpha.
Yeah, they're not asset gatherers, they're performance focused.
Exactly. So typically where an investment head is the head of the business, they'll see that as their path to success. So all the managers that we hire tend to have that criteria of, their focus on alpha, that's their first reference point when they talk to us. So that's an important part. The types of companies we're buying. So India is a great structural story. Demographics is great, but every market and every company goes through cycles. What happens in a cycle? You are on top market share of a great industry. It's growing fantastically. Everyone's making money. Everyone's adding capacity. All of a sudden, there's too much capacity. No one's making money, and everyone's cutting prices, and people are going broke. So, what happened to this great industry and this great company where everything was going along swimmingly? So we do believe when people talk about India's expensive valuations, a large part of what happens is a stock becomes priced for infinite growth. If you're trading at 50 times, there's almost a view that for the next 50 years, your earnings will keep being generated at the same strong pace. So the best way we feel to invest in India is find an industry that perhaps is not so profitable, going through some consolidation, and invest with the largest market share or the second largest, with the view that when the industry turns positive, that company is going to walk away with the lion's share of profits because of the moat that it has, and because of the fact that irrational or non-economically competitive players are going to disappear. I'll give you an example. Post-COVID, we bought an airline company, and most people would say aviation, really. It's overly cyclical. It's not a great structural story. But think about the case of India, where people are going from I need to eat to I want to fly. Just simple things like the cost of airfares have come down. Oil prices are lower than where they were. And post-COVID, where valuations were much lower, it was a great time to identify a company like this with the view that more money is getting allocated to the discretionary budget. So Indigo, or Interglobe Aviation as the company is called, has over a 60% market share. It is a difficult industry. We've seen, the tragedy with Air India just last week. So things can happen. But I think if you buy a great company at a decent price, when all your competitors are struggling, then when those competitors start making money, you will make abnormal profits. So those sort of businesses you can buy and hold from a low starting point.
And talking about, like, say, the digitization that's going on, do you look at Western equivalents like, say, hey, we know that the likes in Australia of REA Group and car sales and things like that have been fantastic platform businesses. And do you look for the local equivalent?
Yes. Well, we need some clarity on who is going to be one of the winners, because quite often the valuations you pay when there's no earnings yet and it's promise can be excessive in India. There is a stock called D-Mart, which is the Walmart equivalent. The equivalent of this technology sort of type companies and AI that we're looking for can be in some simplistic, boring industries in India. So retailing typically used to be mum and pop corner stores. And then D-Mart comes along and does a Walmart type model and starts hypermarket retailing. And you've got quickly a valuation of 100 times. So you sit there and think, okay, great business. It's going to win so much more market, but now I'm really paying for it and it's priced to over perfection. So I think we need to identify which company is going to have success, and then look at realistically, is that valuation just escaped us, or have we missed it?
That sounds like one of the toughest components then is that valuation. So the actual identification of some of these businesses, because you have seen it played out in other developed markets, might not be as difficult, especially if you're going towards the dominant market player, or maybe one or two of them. If you like the industry as a whole, but valuation seems to be the bigger issue.
Yeah, it can be your friend and it can be against you. If you have got onto the trade early, you can basically say as a fund manager, hey, I hold this one stock, nothing else matters. I'm going to ride it all the way up into the top 50, top 20, top 10. But, if you've bought it 3/4 of the way along the journey, then perhaps that same excitement is difficult to identify, and you're perhaps looking at a 1-year trade rather than a 10-year trade.
What other sectors are prominent in your portfolio?
I think from an overall perspective, any emerging market will tend to have somewhat of a dominance in financial services, because we're going from simple things like penetration stories, underbanked, to banking, use of credit, use of financial instruments which come from zero. So in India, the index as such has a high weighting to financial services of about 25%, still reasonably diverse, but that has certainly got some stories over the last 10 years, which have been, they make Commonwealth Bank look like a flat line in a graph. There's a company called Bajaj Finance that for the last 17 years has averaged 50% growth, right?
Sorry, can you repeat that?
50% growth in earnings over the last 17 years.
17 years.
Yeah, and it's done something like, I don't know, close to 100x plus.
That's amazing.
And this is, what does it do? So this is the interesting thing. It's not like something high tech or, something that we don't understand yet. It simply lends to people who want a motorbike, a house, a car loan, something basic. And it was at the right place at the right time when financialization was penetrating across the country. So great data analytics to almost know when someone needs money before they know themselves. And good management has really meant if you hold a stock like this, perhaps you can make some other errors elsewhere because it's going to wipe out a lot of the poorer performers that you had in your portfolio.
Is that a significant area in tech? Because for a long time, of course, India has been an outsourcing hub for the world as far as tech, but is that talent now has been turned inward on these Indian businesses?
Yeah, so it's almost like a osmosis of, because they have so many tech professionals, areas like fintech can flourish quickly. And, I mentioned data analytics. So, companies like this really have a great understanding of what their customers' preferences are and choices are. So you're right. Indian companies from 30 years ago, which started as pure outsourcing lower labor costs, are now helping businesses globally migrate to the cloud, build a digital platform, and leading the world in AI integration. They're not necessarily innovative on the AI side, but they are helping businesses integrate this into their business model and build efficiencies.
Excellent. Magunthan, this has been a great conversation. I've really enjoyed it. But a couple of questions that we always ask of our people just to wrap up. Who do you read? If you're following Indian market kind of thought leaders and stuff like that, whose email do you always open? Is there someone, apart from the India Avenue newsletters, which we'll definitely link to, who else would you recommend people, have coming into their inbox once a month, once a week?
Oh, look, there's been long-term positive views on India from people like Mark Mobius, who ran money for Franklin Templeton for many years. If you listen to some of the guys who have been very successful, like Ray Dalio at Bridgewater, seem to understand the change in the new world order and which economies are going to be more successful at pushing themselves into supply chains, going up value chains. So I think to understand the India story, you have to be willing to accept that change will happen, and that change will generally be positive for some of the emerging market countries. And then that'll open up your mind towards, okay, how can this play out and how do I need to position myself?
And one more question as well. I know you actually take groups of your investors across to India. What's the most common reaction? What surprises them the most when they're there?
Yeah, so we feel, the financial advisors, high net worth family offices that come across with us generally leave with a positive tone. We've found where they come with some skepticism and, look, I've been in India in the 90s and the business didn't work and couldn't get my money out, and all those classic cliche, there's cows on the road and, I know we're going to have trouble in traffic. They tend to leave with, wow, the people we spoke to were highly intelligent. There was a significant proportion of the population could speak English. Service standards were very good, and some of the top brass that we met in terms of, owners of the businesses and people who had made money, brokers across the board, we found, very insightful, knowledgeable people. That's the general thought process, is people are surprised by the sheer advancement, I suppose, of, everyone, which is at the core of why you invest. You get greater inclusion, greater, I suppose, opportunity to go from lower to middle to upper class.
And so on to those two questions that I said before that we always ask everyone. Magunthan, if you could go back in time and tell a younger version of yourself something about life or business or investing, what would it be?
Well, I think, being contrarian, definitely, because just thinking what everyone else does, all my mates were flying to London or New York or San Francisco, and I was going to Mumbai, and everyone was like, what are you doing? You're going backwards, we're going forwards. So I think I'm not necessarily saying they were wrong. I'm just saying you've got to find your niche, and then you want to be the expert in your niche, and at some point your time will come. Be patient.
Yeah. Keep working, be patient. Correct. It'll come.
Yeah, and don't worry if everyone else is different.
Good advice. Magunthan, something that I always ask people, and it could be in Sydney, or it could be in anywhere in India or anywhere in the world. I don't care. It's because it's your answer. Me and you, we're going out for lunch. Okay, the out of office is on. We're not coming back to the office. Where are we going and what are we eating?
Oh, geez. Where are we going? And okay, so I have a real strong preference for Mexican food. Maybe it's this whole emerging market belt, and I generally find I have that interest in countries where perhaps there's not a lot written about or understood. So we're having something unique, something that we both haven't tried. And, so that there's in case our conversation dries up, there's always something extra to talk about as well.
I'm sure that wouldn't happen, especially if we're having Mexican, maybe a margarita or two as well.
Absolutely.
Magunthan, I really appreciate you spending the time with us, walking us through the environment and the economic environment that is India. Your fund, India Avenue, is listed on SIBO. So that is, if you've got a CommSec account, an AbTrade account, if you've got any general brokerage account in Australia, if you type in the code IAEF, you'll be able to find your listed active managed fund available as an ETF on your brokerage platform. So type in the code IAEF. Magunthan, really appreciate you joining us today, and I'll tell you what, I think it'd be great if we were to get you on again after, say, one of your trips back from India.
Sounds good. Look, I really enjoyed talking to you and, discussing India on this platform, and be more than happy to do it anytime.
Excellent. Great. Thanks, Magunthan.
Thank you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.